Understanding quantitative tightening, impacts on the economy and financial markets. This video will explore how quantitative tightening affects the economy and financial markets, providing insights into its broader implications. Quantitative tightening, or QT, is a monetary policy tool used by central banks to reduce the amount of money circulating in the economy. This process involves the central bank selling off assets, such as government bonds, that it had previously purchased during periods of quantitative easing. Unlike quantitative easing, which aims to increase money supply by purchasing financial assets, QT works in the opposite direction. By selling these assets, the central bank effectively removes money from the economy, which can lead to higher interest rates and reduced spending. This tightening of monetary policy can have significant impacts on financial markets and the broader economy. For example, higher interest rates can make borrowing more expensive, which can slow down economic growth. Investors may also react to QT by selling off stocks and other assets, leading to market volatility. Understanding QT is crucial for navigating the complexities of modern financial systems. Central banks implement QT by selling government bonds or letting them mature without reinvesting. This process reduces the central bank's balance sheet and increases interest rates. By selling bonds, the central bank pulls money out of the economy, which can lead to higher borrowing costs. Additionally, as bonds mature and are not reinvested, the supply of money in the economy decreases. This tightening of monetary policy aims to control inflation and stabilize the financial system. The overall impact of QT can be significant, influencing everything from mortgage rates to stock market performance. The impacts of QT are far-reaching and multifaceted. It can lead to higher bond yields, lower stock prices, and increased market volatility. Consumers may cut back on spending due to higher borrowing costs and economic uncertainty. Investors often react to QT by adjusting their portfolios to mitigate risks. Central banks use QT to control inflation and stabilize the economy, but it can also slow down economic growth. Small businesses might struggle with higher interest rates, leading to reduced investments and potential closures. On a global scale, QT can affect international trade and investment flows, influencing global economic stability. Economists and analysts closely monitor QT's effects to predict future economic trends and advise on policy adjustments. Historically, QT has been used by central banks like the Federal Reserve to control inflation and stabilize the economy. For instance, during the 2017 to 2019 period, the Federal Reserve implemented QT to reduce its balance sheet, which had ballooned due to quantitative easing measures taken after the 2008 financial crisis. Experts like Janet Yellen and Jerome Powell have discussed the importance of QT in maintaining economic stability. They believe that future implementations of QT will continue to play a crucial role in economic policy, especially in times of economic uncertainty. As we move forward, understanding the impacts of QT will be essential for policymakers, investors, and the general public to navigate the complexities of the global economy. To fully grasp the significance of quantitative tightening, it's essential to delve into its historical context. The origins of QT can be traced back to the early 20th century, when central banks began to experiment with various monetary policies to control inflation and economic stability. The concept of tightening monetary policy gained prominence during the Great Depression, as central banks sought ways to manage deflationary pressures and stabilize the financial system. Over the decades, QT evolved, becoming a more structured and strategic tool in the arsenal of central banks. In the 1980s, under the leadership of Paul Volcker, the Federal Reserve adopted aggressive tightening measures to combat hyperinflation. This period marked a significant evolution in the understanding and application of QT. The lessons learned during these times laid the groundwork for modern QT practices. Fast forward to the early 21st century, the global financial crisis of 2008 prompted unprecedented quantitative easing measures. As economies began to recover, the need to unwind these measures gave rise to the contemporary form of QT we recognize today. Understanding the historical evolution of QT provides valuable insights into its current application and future trajectory. As we continue to navigate economic challenges, the lessons from the past will undoubtedly inform the strategies of tomorrow. As we look towards the future, the landscape of quantitative tightening, QT, is poised for further evolution. Central banks around the world face an increasingly complex economic environment characterized by rapid technological advancements, geopolitical tensions, and shifting demographic trends. One of the primary challenges that lie ahead is the balancing act between controlling inflation and supporting economic growth. Central banks must navigate this delicate equilibrium, ensuring that QT measures do not stifle recovery or exacerbate economic disparities. Additionally, the global interconnectedness of financial markets means that the ripple effects of QT policies in one major economy can have far-reaching implications for others. However, with challenges come opportunities. Innovations in financial technology and data analytics offer central banks new tools to monitor and respond to economic indicators more precisely. Enhanced communication strategies can also help manage market expectations and reduce uncertainty, making the implementation of QT more transparent and predictable. Moreover, the lessons learned from past QT experiences provide a valuable blueprint for future actions. By understanding the historical successes and pitfalls of QT, policymakers can design more effective strategies tailored to contemporary economic conditions. As we move forward, the future of quantitative tightening will undoubtedly be shaped by a combination of historical wisdom and modern innovation. The ability to adapt and evolve will be crucial in navigating the complexities of the global economy, ensuring financial stability and fostering sustainable growth for generations to come. Quantitative tightening, QT, does not affect the economy uniformly. Its impacts ripple through various sectors, each experiencing distinct challenges and opportunities. Let's explore how QT influences key sectors like housing, banking, and consumer spending. Firstly, the housing market often feels the immediate effects of QT. As central banks reduce their balance sheets, interest rates typically rise, leading to higher mortgage rates. This can dampen demand for home purchases, slow down housing price growth, and potentially cool off overheated markets. Prospective homebuyers may find it more challenging to secure affordable financing, while existing homeowners might face increased costs on adjustable-rate mortgages. Next, the banking sector also experiences significant shifts due to QT. Higher interest rates can improve banks' net interest margins, potentially boosting profitability. However, the increased cost of borrowing may reduce loan demand, impacting revenue from lending activities. Additionally, banks must carefully manage their liquidity to ensure stability in a tightening monetary environment. The interplay between these factors requires banks to adapt their strategies, balancing risk and opportunity. Consumer spending, a critical driver of economic growth, is another area where QT's effects are felt. Higher interest rates can lead to increased borrowing costs for consumers, affecting everything from credit card debt to car loans. As a result, households may become more cautious with their spending, prioritizing savings or debt repayment over discretionary purchases. This shift can slow down retail sales and impact businesses reliant on consumer demand. In summary, quantitative tightening has far-reaching implications across different sectors of the economy. Understanding these nuanced impacts is crucial for policymakers, businesses, and consumers alike. By anticipating and adapting to these changes, stakeholders can better navigate the complexities of a tightening monetary landscape, ensuring resilience and stability in the face of evolving economic conditions. While quantitative tightening, QT, is a monetary policy tool utilized by many countries, the approach and impact can vary significantly across different regions. In this chapter, we will explore how various countries implement QT and the broader global implication. Firstly, let's take a look at the United States. As the world's largest economy, the Federal Reserve's QT decisions often set the tone for global markets. The Fed typically reduces its balance sheet by not reinvesting the proceeds from maturing securities, which can lead to higher interest rates. This approach aims to temper inflation and stabilize economic growth. However, the ripple effects are felt worldwide, as tighter monetary conditions in the US can lead to capital outflows from emerging markets, increased borrowing costs, and currency depreciation in other countries. In contrast, the European Central Bank, ECB, has its own unique approach to QT. Given the Eurozone's diverse economic landscape, the ECB must consider the varying economic conditions of its member states. The ECB may opt for a more gradual reduction in asset purchases to avoid destabilizing weaker economies within the Union. This cautious approach helps maintain cohesion, but can also prolong low interest rate environments, impacting savers and financial institutions differently than in the US. Japan presents another interesting case. The Bank of Japan, BOJ, has been engaged in quantitative easing, QE, for decades, resulting in a massive balance sheet. Implementing QT in Japan poses significant challenges due to the country's prolonged low inflation and economic stagnation. The BOJ may adopt a very slow and measured approach to QT, if at all, to avoid triggering deflationary pressures and economic contraction. China's approach to QT is also distinct. The People's Bank of China, PBOC, often uses a combination of monetary tools, including reserve requirements and open market operations, to manage liquidity. China's unique blend of market mechanisms and state control allows it to implement QT in a manner that supports its broader economic goals, such as maintaining financial stability and supporting strategic industries. However, China's QT policies can have significant implications for global supply chains and commodity markets, given its role as a major global manufacturer and consumer. Finally, it's important to consider the global implications of these diverse QT strategies. As major economies tighten monetary policy, global financial conditions can become more restrictive. This can lead to increased volatility in international markets, shifts in capital flows, and potential economic slowdowns in countries heavily reliant on external financing. Moreover, the interconnectedness of global trade means that QT in one region can have far-reaching effects on supply chains, commodity prices, and overall economic stability. In conclusion, while the principles of quantitative tightening are broadly similar, the implementation and impact vary widely across different countries. Understanding these nuances is essential for global investors, policymakers, and businesses as they navigate an increasingly interconnected and complex economic landscape. As we wrap up our exploration of quantitative tightening, QT, it's essential to compare it with other monetary policies such as quantitative easing, QE, and interest rate adjustments. Understanding these different tools can provide a more comprehensive view of how central banks influence economies. Let's start with quantitative easing. Unlike QT, which reduces the money supply by shrinking the central bank's balance sheet, QE aims to increase the money supply. During QE, central banks purchase large quantities of financial assets, such as government bonds, to inject liquidity into the economy. This lowers interest rates and encourages borrowing and investment, which can stimulate economic growth during periods of recession or low inflation. Now consider interest rate adjustments. Central banks often use interest rate changes to control economic activity. Lowering interest rates makes borrowing cheaper, encouraging consumer spending and business investment. Conversely, raising interest rates can help cool an overheating economy and curb inflation. While QT and QE directly impact the central bank's balance sheet, interest rate adjustments influence the broader credit conditions in the economy. Each of these tools, QT, QE, and interest rate adjustments, has its own advantages and limitations. For instance, QE can be highly effective in boosting economic activity, but it can also lead to asset bubbles and long-term financial imbalances. QT, on the other hand, can help normalize monetary conditions but may risk slowing down economic recovery if not carefully managed. Interest rate adjustments are a more traditional tool, but they can be limited in effectiveness when rates are already near zero, a scenario often referred to as the zero lower bound. In practice, central banks often use a combination of these tools to achieve their policy objectives. For example, during the 2008 financial crisis, the Federal Reserve initially cut interest rates to near zero and then implemented QE to further support the economy. As conditions improved, the Fed gradually shifted towards QT to balance its monetary policy stance. Understanding the interplay between these different policies is crucial for investors, policymakers, and businesses. Each tool has a unique role in maintaining economic stability, and central banks must carefully calibrate their use to navigate complex economic landscapes. In conclusion, while quantitative tightening is a critical component of monetary policy, it is just one of several tools available to central banks. By comparing QT with QE and interest rate adjustments, we gain a deeper appreciation of the nuanced strategies central banks employ to manage economic conditions and ensure long-term stability. Thank you for joining us on this journey through the intricate world of quantitative tightening and its broader implications. Stay tuned for more insightful content on the ever-evolving landscape of global finance.